But the real headline was the jobs reporting accurate?
Right.
Hello again. Welcome. My name's Robert Schein with my co-host Madison Evans for the Few Podcast. Hello, Madison. How are we doing today?
Hi, Rob. I'm doing well. How are you?
Good. We're going to have some fun. Today, we're kicking off season 3. Episode 1, Follow the Money. We're gonna get into it. We're gonna do a lot more hot topics, real-time relevant, rip from the headlines, what markets are paying attention to, and that's important because that's what moves markets. You know, there's so much financial news out there, so many financial headlines on a daily, hourly basis.
Right.
But what we do at Blanket Schein Wealth Management, as you know, is you and I both produce and publish the market insights and observations biweekly. And so we send that to our audience, our community, our clients. And what we try to do is boil it down to just the 3 topics of that week or of that day of what the market pays attention to, right? Follow the money. Because there's so much out there and you're like, wait a minute, what do I pay attention to? And sometimes you don't want to be catfished or pulled in the wrong direction as it relates to your money, right?
Right.
So we produce that for our clients. We produce that for our community. You could always subscribe to that if that's something you're interested in. And what's really important is it really keeps you focused. Obviously, what is it? My mind on my money and my money on my mind, right? It's always keeping you focused and engaged. Not, everyone has a full-time, real-time job, whether it's managing your household with your kids or you're managing a business, but you can't take your eye off the ball, but you also don't want to be distracted.
Right.
Hey, this headline or that headline. So we're going to boil it down, not only today's episode, but in future episodes of our podcast for this season.
And this episode is very timely because you just got back from New York City doing a media tour. You were on CNBC, Fox Business with Charles Payne, Schwab Network, and Yahoo Finance TV. And there's also been a lot of news in the headlines. You had great conversations in New York. Why don't you share with our audience a little bit more about the conversations you had and just your media tour in general?
It was a very exciting week in New York. We bounced back and forth. We're going to New Jersey to CNBC's headquarters bright and early in the morning. So it's, 2 o'clock in the morning Pacific time, 5 a.m. Eastern Standard Time.
Right.
And so we're really not sleeping when we're back there, but it's great. So when you're in studio, the financial headlines are coming at you. You have to be in tune 24/7. So that's how I kicked off the week on basically early Monday morning in the CNBC studio. And it was great. It's always fun to be back. It's always fun to contribute. And on those episodes, they ask us, ultimately, not only what we like in the market as it relates to sort of investment ideas, but more importantly, where they see the economy at that moment in time, and then what's relevant that week, what's going to move the markets. And so that was my conversation on CNBC. Later that day, we had Charles Payne. We go to Fox Business, and Charles is fantastic. And so to be sort of on camera with Charles, I love him. He's very dynamic, such a smart, intelligent, one of the best in the business. But yeah, back and forth. One of the questions that he asked me, Madison, was, what do markets really care about? What's really going to move the markets? And at that moment, this is before last Friday's job report, which really sent the market spiraling down because it was a disappointing jobs number. But that Tuesday, when I was sitting there with Charles Payne, I specifically said, it's going to be the jobs. The Federal Reserve had a 2-day meeting. What does Jerome Powell think? What's going to be the key from the Federal Reserve at that moment? And I really believe that the economy is not right where it needs to be. And that actually indicated and confirmed what I was talking in my conversation with Charles about that the jobs number, which is kind of ironic that not only over the weekend it was weak, but the Bureau of Labor Statistics head was fired by President Trump because of data that is questionable. So really what happened is the data that came out, the print report that was less than favorable on the jobs number disappointed Wall Street. Wall Street traded down as a result. But the real headline was the jobs reporting accurate?
Right.
And if it's not accurate, I mean, that was the worst number that we've seen in 2 years, number one. Number two, keep in mind, the Federal Reserve, based upon their information or their policy, based upon that jobs data, it's exactly what they said. And in this meeting last week, Jerome Powell basically said, we're concerned that we don't have the right data that it's actually questionable as to the accuracy of the data. What's going on? Like the Federal Reserve is data dependent. They've said so for the last 2 years of policy, but now they're questioning the data that's coming out there that they can't base policy based upon that. So that's kind of was the biggest headline in the story that came out this last week. Again, I did talk about that with Charles Payne earlier in the week. And then we had Yahoo Finance, which is always fun. And then obviously Schwab Network, which is on the floor of the New York Stock Exchange. A little side note on that. It's so fun to be on the floor of the stock exchange. I'm a little kid.
Sure.
When I'm there every single time, there's so much going on there. Mm-hmm. And what's amazing is that when you're sitting in the conversation, you're having the conversation, you're being interviewed, real business, right? Real money, billions of dollars are trading hands right in front of you, behind you. And it's extremely distracting. So I could be having a conversation and actually in the Schwab Network, a trader came up right behind me and I almost had to stop the interview right there, Madison. It was like, excuse me, can I help you? And he was looking at the board right above us because there was a lot of real-time data information that he needed. It just goes to show you that it doesn't matter. You know, we could be having a conversation, but real business is being done even as we speak. So you have to stay focused, engaged, locked in. But it's always exciting to be on the floor of the New York Stock Exchange when I'm back in New York. And then Yahoo Finance, we did talk about the consumer. The consumer, which is, again, relating back to the Federal Reserve. They asked me, do I think that the Federal Reserve is going to lower interest rates? And even last week, before all this data on the labor markets came out, I said, yeah, the betting odds is 67% that the September, I think it's September 15th, Fed meeting, they're going to lower, it's priced in. Markets are pricing in a lower interest rate. So why that's important is because the consumer, I believe, let's say credit card debt's piling up. Or the velocity of money. Why does the Federal Reserve raise interest rates? It's basically the velocity of money moving throughout the economy. You can think of it this way. They're pricing money to be more expensive, essentially. So they want to slow down, price it a little bit higher for the velocity of money to slow down. So if you bring down interest rates, Madison, you're going to make the price of money, basically borrowing, a little bit cheaper, right? So that speeds up the velocity of money, heats up the economy. Obviously, President Trump and his administration want the economy to start growing. We did see a GDP print of 3%. And, you know, the gross domestic product is basically what happens in the economy of like all the goods and services. They basically just take it all together and say, okay, are we growing or are we shrinking? So the last quarter was a 3% number. Why that matters, Madison, is that statistically, and it's been proven that if you have let's say if 2% GDP in the United States to a 3%, so if you grow it by 1% for every man, woman, and child, 330 million plus in the United States, that wealth effect is over $26,000 per person.
Wow.
So that's why it matters. It's the wealth effect of bringing down, let's say, you know, cost of goods. Inflation is an issue. It's a wealth effect of actually people, you know, spending money and having more money and having their wages go further. I think that's another issue that what the Federal Reserve is trying to help with right now. And another topic we talked about was if you lower interest rates, you're also going to help the housing market. And the housing market has been frozen for the last 2 years. Why that matters, let's go back to the GDP. 15% of the numbers that add up into the GDP are housing related. So again, if you lower interest rates, you basically unlock the housing market because you got a lot of 3% mortgages there. We talked about this in Yahoo Finance in that conversation when I was back there. So a lot of people are sitting on 3% mortgages. They're not going to go anywhere. Right? We have a 7% mortgage right now. Yeah. And it's been at a 7 handle for quite some time. Now, 7%, over 60% of the time of mortgage interest rates over the last, 100 years has been 7% average. So it's not uncommon to have a 7% mortgage. It's just like all of us remember, or we have locked in a 3%, or we remember a 3%, or even a 4% mortgage. Right. So a good percentage of the real estate market is basically sitting on those, and there's no reason to trade up for a more expensive, basically cost of a mortgage. So that's what's happening. So if we could see September, maybe December, the Federal Reserve lower interest rates, we believe they will. It'll start unlocking real estate. It'll start providing some relief to the consumer. And then we'll see how the job markets plays out. We're going to see a couple more economic reports between now and September. The Federal Reserve at least now has at least some more data between now and their next meeting to basically make their decision and their timely decision. So we'll see that play out in September.
Well, we're happy to have you back, and it's always great to hear your insights on your interviews.
This episode is brought to you by Schein Wealth Management, serving the Coachella Valley for the first 40 years and built for the next 40 years. And for more information about Schein, it's scheinwealthmanagement.com.
Another thing you discussed in your interviews is just the seasonality of the market. Do you want to talk on that a little bit more?
Yeah, we did talk about that, and it is important. Historically speaking, if you look at the calendar year and how the markets trade, you see a seasonality effect. What that means is sometimes markets take a breather, especially if they've been up year to date. Obviously, we had a big pullback in April, right? Mm-hmm. As soon as President Trump announced tariffs, the markets basically sold off. We at Schein Wealth Management for our clients took advantage of that. So we always carry some, cash equivalent that's earning some, a higher percentage than just your savings rate at the bank. But we also then proactively deploy that when we see what we call value on sale. So we buy high quality companies that are on sale. And we did that in April for our clients. Now, moving forward, we could see another seasonality effect because historically speaking, if you look at August, September, October, markets then do take another breather. Okay, we can't predict what it's going to do. Again, markets could take off. We don't know based upon the big beautiful bill and all the incentives that pull through. So that could heat up the market. But we've seen a lot of seasonality effect. We're positioning our clients to take advantage of that once again. Mm-hmm. We like that opportunity. And again, you just have your shopping list as we do for our clients of just great companies, well run, well positioned, sort of moats around their businesses, regardless of sort of even if we hit a recession at some point in time in the future. But let the market come to you, and then we jump on that opportunity as we see fit. But the seasonality effect is basically the third quarter. Usually the S&P takes a breather, and then hopefully we have a Santa Claus rally by the end of the year.
Yes.
But we're going to see how this plays out. A lot of economic news and a lot of news I'm sure will play out. But what really is the underpinning right now, our earnings are still hanging in there. Mm-hmm. Companies are still growing both on the top and the bottom line. And that's why we still are positive moving forward on the equity markets. We just want to choose our spots when we jump in.
Rob, last question for you. What do you see in the back half of the year, and what are you telling investors going into the last 6 months of 2025?
Yeah, it's going to be a race. We made a lot of progress this year. Number one, the big beautiful bill. That's passed. It gives a lot of incentives for small business owners, big business owners, and it gives a lot of certainty to the market. So there's a lot of incentives built in that are pro-growth. So we could see not only the end of this year, because it's retroactive for business owners, if you will, as well as the personal rate. Everyone now knows what the tax rate's going to be personally. So there's a lot of certainty built in, and we got past that. So a lot of work has already been done from a policy standpoint that's very positive for the markets moving forward. Time will tell. Now, also, the big question mark still to this day in the Federal Reserve brings it up, and everyone brings it up, and it's on the topic every single day. What's the net impact of tariffs?
Yeah.
Right? And the reality is that we will have tariffs higher than where we started.
Right.
Right? And the good news is we're going to bring more revenue into the United States. Essentially, it's, President Trump and his thought process and what he ran on and his policy is, listen, we are the largest consumer in the world, the United States, number one economy in the world, largest consumer. And he's basically just saying, hey, wait a minute, do you want to have access to United States consumer? Right? Because we all know how to spend in the United States.
Yeah,
right?
Definitely.
So he's just basically saying it's a pay to play. If you want access to the United States consumer, which we'd like to spend money on just some stuff and some stupid stuff, right? You have to have pay to play. That's all it is. And that's no different than a grocery store. You go into any grocery store today and everything on the shelf, every single one has paid that grocery store to be, whether it's on the end cap, whether it's going to be at eye level. So all of the the best cereals that you like are all at eye level. That's paid for that shelf space to be at eye level. So next time you're in the grocery store, pay attention. Everything in that grocery store, those companies paid to be in the grocery store. No different than what we're going to see with the tariffs. How do they play out? Are they going to be negatively impacted, meaning that sort of business is going to pass it on to the consumer? Is it a one-time charge? Is it a longer-term charge? Is it inflationary for all of us? Again, the good news is we're making progress on tariffs, and only time will tell as it relates to that. It is very healthy for our debt and deficit in the United States. And again, starting at 2%, or some of these countries were paying nothing to access the U.S. consumer. You can't disagree with that. It's going to help the United States one way or another. So that will be playing out. But the question that you asked is, how do you see the back half of this year? We're just going to keep our eye on earnings and how the companies are going to work through maybe the incentives on the big, beautiful bill and how that relates to their bottom line. What, can they, buy equipment right now and get 100% accelerated depreciation, which means a big tax write-off or a big tax benefit for them? Or are the tariffs, every company is going to say, oh, I've got $1 billion hit because these extra tariffs are going to impact our bottom line. So negatively earnings, how they're going to be affected by each one of these companies. I will submit for consideration. Companies now are stronger than we've ever seen. And I think one of the reasons for that, Madison, is because we got through COVID. So COVID got every single business, small, large to small, every business owner to rethink, okay, how can I become more efficient? How do I work my supply chains? How do I talk to my distributors? What if this ever happens again? So every business in the United States went through becoming sharper and more basically efficient. They got rid of a lot of stuff. So I think that COVID effect put everybody's business on notice on how to get more efficient. And then you add in incentives from this tax bill. I think they'll figure out how to navigate the tariff situation just as well, if not better. But we're going to watch earnings. We're going to see how that plays out. We believe the economy is still growing. We believe we're going to see interest rates lower. That's going to help the consumer. That's going to help then follow consumer spending more money, and then that's going to help corporations with earnings. And then we're going to see, how the markets perform as a result of that. But I think we're going to see a positive effect on between now and year end. Again, keep some cash. Take advantage of opportunities, seasonality in the market, but jump on some good quality names and have your fresh money buy list when the opportunities are presented.
Awesome. Well, thank you for all of your insights. I think everyone will find this episode very informative. And as we always do, I'm going to close us with a quote by Warren Buffett. And the quote reads, "Be fearful when others are greedy, and greedy only when others are fearful."
Great quote from Uncle Warren.
Yeah.
Can't disagree.
Thank you again, everyone, for listening. Please like, subscribe, and share this episode with someone you think would find it informative. And look out for our next episode of The Few Podcast. Another exciting announcement for The Few Podcast. We are currently reviewing sponsorship requests. We are eventually going to have sponsors on our episodes. So if you or anyone you know is interested in sponsoring The Few Podcast, we will have an email in the description of this episode that you can reach out to us through.
This podcast is brought to you by David Field, producer. It is produced and directed by David Field and Kristen George. And its mix, edit, and socials by Kristen George. Schein Wealth Management is a group of investment professionals registered with Hightower Services, LLC, member FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other information contained in this research is provided as general market commentary. It does not constitute investment advice. Schein Wealth Management and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Schein Wealth Management and do not represent those of Hightower Advisors, LLC, or any of its affiliates.